Hey everyone, happy Monday. It's March 25th, 2024. We just ended a big week of central bank meetings. Policy rates have peaked for developed markets, with the exception of Japan, of course. Even Australia dropped their hiking bias this week, and the ECB has all but confirmed rate cuts starting in June, with a surprise cut from the Swiss National Bank paving the way even further. The Bank of England's decision to hold rates was expected. However, one member already advocated for cuts, which gives us a hint that even the UK is getting closer to easing. Moreover, Governor Bailey came out and said that every meeting from now on is live, which means that rate cuts are on the table. We continue to see the order of rate cuts to be the ECB in June, the Fed in July, and the Bank of England in August, with Australia sometime in the fourth quarter. Now, we expected the Fed to continue projecting 3 cuts during the meeting because we expect them to retain that optionality in an election year. What we didn't expect, however, was the Fed chair being so dovish in the face of stickier core inflation and rising headline inflation. What was interesting, however, from the Fed was the summary of economic projections. The Fed has certainly lowered the threshold to begin cutting rates. Firstly, they increased the GDP forecast, signifying a stronger economy. Secondly, they increased the inflation forecast to 2.6% from 2.4%, which means they're accepting a higher level of inflation for the year. And finally, they reduced the unemployment projection to 4% from 4.1%. This is just 0.1% away from the current 3.9% unemployment rate. Taken together, all 3 conditions make the path for the Fed to start cutting rates much easier. At this stage, the Fed seems content to shrug off the reflationary scenario in the economy and focus on reducing the cost of borrowing, particularly for the government and big businesses. We think the bigger issue here, however, is that with the backdrop of fiscal spending, that is the government spending, keeping rates higher for longer makes it very expensive for the US government to keep spending the way they are. The Congressional Budget Office, CBO, expects the interest on US government debt to balloon to $840 billion in 2024 and to further rise to $12.4 trillion in the next 10 years. So the Fed has 840 billion reasons to cut rates. But the question is, are they the right reasons to cut when the US economy is effectively overheating? The Fed needs to be cautious here, because cutting too soon and too aggressively may be a policy mistake. They've raised rate projections from 2025 and 2026, but they are also considering slowing the pace of quantitative tightening, which is QT. This added liquidity could continue to keep financial conditions easy and therefore inflation higher for longer. What does this mean for the markets? Well, with this backdrop, we're likely to see the markets remain bullish and gradually broaden out. While tech continues to remain the sector of focus in this part of the cycle, we're more interested in sectors of the market that still have room to catch up in terms of earnings and valuation. We like industrials, defense, energy, materials, and some healthcare for this part of the cycle. Thank you for listening, and we hope you'll join us again.